Carnival are the largest cruise line operator in the world. Since the global pandemic, it has been forced to put its operations on hold and has not been earning as a result. Last year, the company posted an annual net loss of $10 billion and saw their share price crash by over 50%. With the rollout of vaccines across most Western countries and possible reopening of international borders, cruise line operations could resume in 2021. So is now the right time to invest in cruise line stocks? Well, in today's video, we will analyse Carnival and compare them with their main competitors to assess whether the company is well positioned for a recovery. So is Carnival's ship about to come in, or are they still sailing on stormy seas? Let's find out as we analyse Carnival and cruise stocks on today's Investment Store. Welcome to the Investment Store, the personal finance channel that reviews a diverse range of investment asset classes from stocks and ETFs through to real estate and cryptocurrencies. If you enjoyed this video, please click the like button and leave a comment. And if you like our content, then please subscribe to the channel to become part of the Investment Store community and hit the notification bell to ensure that you never miss an episode. With that said, let's commence with today's video. Carnival Corporation is a British-American cruise operator and currently the world's largest travel leisure company with a combined fleet of over 100 vessels. The company operates 9 cruise line brands, which include the likes of Ada, P&O, Costa, and Princess Cruises. Carnival visits over 700 ports around the world and carries over 12 million passengers per year. Prior to the global pandemic, Carnival were expected to add an additional 17 ships to its fleet by 2025. The company generates most of its income from ticket sales and from onboard revenue derived from gambling, shore excursions, and bar revenues, to name a few. Since the appointment of Arnold Donald as Group CEO in 2013, the company has achieved impressive revenue growth and had doubled its revenues and market share prior to the global pandemic. We will now commence our review of Carnival by completing the Investment Store 4-step approach to analysing stocks. This comprises of first looking at the economic moat of the business, then looking at the company's fundamentals by taking a look at their financial statements and key investment ratios. We will then do a comparison with Carnival and its competitors, and finally we will calculate the intrinsic value of the stock. Once we've completed these 4 steps, we will aggregate the score to generate an ISS. Now, with that said, let's commence with today's analysis. Looking first at the economic moat of Carnival and the intangible aspect. Carnival currently controls over 40% of the global cruise market and has strong cruise line brands. This has not changed much over the last decade, and the company continues to enjoy market dominance. The company has had its fair share of environmental violations and criticism too. For example, in 2016 it was ordered to pay a $40 million fine for releasing oil waste into the ocean, and in 2019 it received a $20 million penalty for dumping plastic waste in the Bahamas. In March 2020, a coronavirus outbreak on the ship Ruby Princess infected over 100 people on board the ship and caused a few fatalities. Carnival were criticised on how they managed the disembarking of passengers from their ship. In response to criticisms regarding environment and sustainability and welfare, Carnival have recently introduced their sustainability goals in an effort to clean up their murky track record. We score Carnival an 8 out of 10 for intangible aspect. Looking next at switching costs, the cruise line industry has significantly high barriers to entry. A new ship can cost between $500 million to $1 billion to build, and there's limited worldwide shipbuilding capacity. A new operator will need to have access to large volumes of capital in order to complete a project. The challenge to new entrants is further compounded by the fact that the majority of operators already have access to the best mooring points, so have monopolized the industry. While there have been some new players entering the sector like Virgin, there hasn't been a serious competitor entering the market in almost 2 decades. For this reason, we give Carnival a 9 out of 10 for switching costs. Looking next at cost leader, Carnival have made incremental price increases on an annual basis over the past 10 years in an effort to improve their return on invested capital. The capital that has already been committed from Carnival has been robust, and assets on the balance sheet indicate that the company has the necessary access to capital that is required to facilitate its growth. This once again highlights the high barriers to entry and monopolistic characteristics of the business, so we scored them a 9 out of 10 for cost leader. Looking at the network effect, Carnival appeals to a demographic that is middle class and over the age of 50. These individuals tend to have a higher disposable income and, most importantly, are likely to have received their COVID vaccines before the majority of the population. So cruise companies like Carnival could see an early resumption of their services, particularly if they apply travel restrictions to holidaymakers. Carnival are likely to be one of the main beneficiaries of forward guidance regarding the coronavirus. So we score them a 8 out of 10 for network effect. Finally, when we consider scalability, Carnival along with Royal Caribbean have the largest fleet in the cruise line sector. This gives them access to a broad geographical market and significant economies of scale. In 2015, Carnival formed CSSC, Carnival Cruise Shipping, a joint venture between Carnival and the China Investment Corporation in an attempt to capitalize on the growing middle class in the Asian market. The Chinese market for cruise travel is expected to grow exponentially over the next 10 years, and Carnival are in a prime position to gain from this. So we score Carnival a 9 out of 10 for scalability. Overall, this gives Carnival a Moat score of 9 out of 10. Let's now complete a fundamental analysis on Carnival. Carnival's revenue had been growing steadily prior to 2020, so we score them an 8 out of 10 here. Net income has been up and down over the past 6 years, showing that this is a cyclical business. Of course, the business made huge losses in 2020, and this is likely to be extended into 2021, so we score them a 5 out of 10 for net income. When we consider the net margin was in double figures for every year prior to 2020 and was growing steadily. With 2020-21 losses in mind, we score Carnival a 7 out of 10 for margin. Next, looking at Carnival's ROA and ROCE, we like to see ROA above 10% and ROCE above 15%. Carnival has not achieved either in the past 6 years, and these numbers appear to be the norm for the cruise line sector. We score ROA and ROCE a 5 out of 10. Looking next at the debt to equity, we can see that Carnival's debt to equity was consistently below 1 prior to 2020, which is good. And for this reason, we score them 9 out of 10. Now let's look at the free cash flow yield. A high free cash flow yield is a great indicator of a company that is trading below fair value. We can see that Carnival's free cash flow yield has been decreasing annually and actually went below 1 in 2019. This is a concern and needs further investigation, so for this reason we score free cash flow yield a 5 out of 10. Next, let's use the interest cover ratio to assess Carnival's solvency during this difficult period. We can see that Carnival had maintained an interest cover above 10 since 2015, which is exactly what we want to see. As expected, this number has dropped in 2020, but we've scored this 7 out of 10 considering past performance. Finally, let's look at Carnival's cash ratio. This is a cash solvency ratio which measures the cash and cash equivalents that a firm has to their current liabilities. We like to see a value greater than 0.5, and we can see that Carnival had not met this prior to 2020. The 2020 increase is clearly the result of a cash injection into the business, so most likely they're taking on more debt as indicated by the increase in debt to equity for 2020. So we score Carnival a 2 out of 10 for cash ratio. So for our fundamental analysis, Carnival have an overall score of 6 out of 10. We'll now compare Carnival against two of the largest cruise line companies in the world, Royal Caribbean and Norwegian Cruise Lines. Between them, these companies control over 70% of the cruise line industry, which is a $37 billion industry. We will also compare them against the Vanguard Consumer Discretionary ETF, which contains holdings in all three of these companies. Looking first at the price to earnings ratio, Carnival has the lowest PE ratio of the group by a margin at only 5, so we scored them a 9 out of 10 here. Next, Carnival's current ratio is the highest of the group this year, although its 2019 current ratio of 0.06 is very low, so we score this a 5 out of 10. This shows that cruise liners, like airlines, which we have analysed in the past, have low working capital. Next, moving on to the dividend yield, Carnival has the highest dividend yield of the group at 5%, so we've scored them 9 out of 10 here. Looking next at the profitability against its peers, for this we have considered 2019 figures rather than 2020 numbers, which may be misleading. Carnival has the lowest operating margin of the group, so we give them a 5 out of 10 here. Carnival's ROCE is joint highest of the group at 8%. Neither is that high, which indicates that the cruise line industry is a low growth industry, and for this reason we score Carnival a 6 out of 10. Looking next at the price to book ratio, and again considering 2019 numbers, Carnival has the lowest price to book of the group with a value of just over 1. We'd ideally like to see this value below 1, however it's still a decent score, so we score this a 7 out of 10. Looking next at the debt to equity in comparison to its group, Carnival's debt to equity is the lowest in the group, so we've scored them a 5 out of 10. Next, let's look at the current interest cover to see how these cruise liners are faring during this period of inactivity. Carnival has the highest cover amongst the 3 companies, although all 3 companies do have low interest cover, showing that the current situation is having a significant impact on their businesses. We give Carnival a comparison score of 5 out of 10 for interest cover. Next, let's look at the free cash flow yield. Carnival's free cash flow yield in 2019 was 0.2, which was the lowest by a margin, so we scored them 1 out of 10 for free cash flow yield. And finally, looking at Carnival's share price performance over the past year, Carnival's share price is currently down by 54% over the past 12 months, which indicates significant upside potential. We score Carnival 9 out of 10 here. Notice that the Vanguard ETF has had a significant return as the fund contains stocks across a broad range of industries, not just cruise liner stocks. Taking all of this into consideration, we have given Carnival a comparison score of 6 out of 10. The final step in our analysis is to determine the intrinsic value of the stock. At the investment store, we prefer to use a discounted cash flow method and Gordon growth model for this type of company to estimate the value of an investment based on a company's future cash flows. Carnival has averaged an annual growth rate of 10% over the past 10 years. Using an average annual free cash flow of $418 million, which includes the financial year for 2020, we calculate an intrinsic share price value of £9.53 per share. If we only consider Carnival's average free cash flow prior to 2020, which stood at $1.45 billion, we calculate an intrinsic share price of £33 per share, which is approximately where the share price was pre-pandemic. Carnival's current share price is just under £14 per share. Although this value is above the current intrinsic value, it's fair to assume that Carnival could resume its operations by the end of 2021, leading to a hike in its share price. So with this in mind, we have given Carnival an intrinsic value score of 7 out of 10. So to recap, Carnival has recorded the following scores in each area of our analysis, and this gives them an ISS score of 7 out of 10. Carnival is certainly worth considering as a rebound stock in 2021, particularly as the COVID vaccine continues to be administered in most countries. The company has a good moat, strong leadership, and fairly solid fundamentals. However, its performance and recovery are entirely dependent on how soon it can resume its operations. If we were planning to purchase this stock, we would ideally like to pay a price that is close to the intrinsic value of £9.50 per share. However, we must bear in mind that the stock hasn't hit this level since November 2020 and has been trending upwards since its Q4 results were published in late 2020. With such high barriers to entry and a large number of holiday makers desperate to travel, we believe that a rebound of this stock is highly likely to occur in the medium term, particularly as more of their customers get vaccinated. Now would probably be a good time to invest in cruise stocks, so we would apply a margin of safety on the current share price of 20%, which would suggest a buy at approximately £11.50 per share. Thanks for watching. If you enjoyed this video, please leave a like and let us know what you think of our findings. If you'd like to learn more about how we analyse assets, then please subscribe to the channel and visit our website. We look forward to seeing you on the next video.